Well, good morning, everybody, and welcome to the TriggerCharts pre-market rundown for April 24th, 2020. And I wanted to take a moment to just thank everybody for joining us today and each and every week on Friday mornings at 9 a.m. in the morning. I'm Andrew Horowitz. I'm the co-founder of TriggerCharts, and hopefully you're having the opportunity to get some great trading involved with some of the indicators that we have available on the TradeStation trading app store. I also want to thank you very much because, you've made us the #1 overall rated and the #1 most popular indicator on the Commander series, as well as our other indicator packages on the TradeStation platform. So I really appreciate that. And it's just a testament, I think, to all the things that we're doing right in terms of making it pretty simple, pretty easy to understand what to do when it comes to investing and exactly how to find those setups. And we're going to talk about a couple of setups today as well. And we're going to go through this along with the fact that we're going to go through some of the other areas of the process with you today. So with that, I want to make sure that everybody is ready to rock and roll. We're going to have any of your symbols that you want to add into the panel that will show up, the chat panel that will show up in a moment, if it's not there already. And I also want to make sure that during these really difficult times, a lot of us are struggling with our sanity and the psychological implications of this whole entire lockdown and confinement, containment, inability to socialize, social distancing. And hopefully what this particular webinar does on Fridays is give you a way to have a kind of a relief and give you the opportunity to ask questions and to find out more about what's going on with the markets, with the economics, and we're going to go over all that. So I want to just tell you that my thoughts are with you and your families, hoping everybody is safe and very healthy and ensuring that you are in good shape. But I want to thank you for joining us in these difficult times. So with that, let's take a look at what's going on with regard to the screens, what's going on here. I'll mention ahead of time that this is a educational discussion. It is not meant as a solicitation to buy or sell any security. In fact, there is no suggestions, recommendations of any kind at all. Investing has a lot of risk. Every time you invest, there is risk involved, and I want to make sure you understand that totally. So let me kind of set my screens up here. All right, and thanks for the kind notes. A lot of chat coming through now, wishing my family well as well. So thank you so much. Before we go any further, I want to show you something. I mentioned this a moment ago. And what I mentioned was that we are the #1 overall most popular indicator in the TradeStation trading app store, as well as the highest rated. You can see that down below. That's pretty cool. But what I really like is all these wonderful reviews. Check out these. These are just the ones from the last however long, right? April 19th, April 21st, April 13th. Getting some great reviews all in one place. Love this. Excellent. The Holy Grail. And that is really, I think, great and what we designed it for. So, a lot of these indicators are slapped together, quite frankly, to provide some kind of mechanism that is just a twist on what it's been in the past, taking some ideas that are out there and changed it a little bit, repackaged it, maybe put a few colors on it, maybe make it look a little sexy. Well, what we did here is we tried to provide a brand new institutional grade mechanism that combines things like volume at price. We use another one called the aileron, which is a momentum indicator using over a dozen different indicators in a much different way. Some old, some I would say traditional indicators, but then changed some of the features of them and did an entirely different remake of how we use a scoring and rating system to then bring one indicator from all of those. So it brings it all together, the best of those. That's called aileron, by the way. If you do, I mentioned that anybody that does sign up for the Commander series will get a free 4-hour course. And that course will cover just a whole bunch of things that you really want to know. I want to mention, let me see if I can find it here on my links. Yeah, here. If you go over to the TradeStation platform, I'm going to put that in the chat right now, a link right there. There is a link to get a free 10-day trial. Every one of our indicators are, if the paid ones are available for you, well, they have a 10-day free trial. Some of them are free. So you can go over to the page on TradeStation and check that out. So where are we? Well, we see futures, the amazing turnaround once again from the lows overnight after we saw some very disappointing news yesterday. We'll get to that, as well as the president talking about how we may be into mid-summer until the social distancing comes to a halt. Well, we got a plus 207 on the futures on the Dow. We got 26 on the ES, the SPOOs, the S&P, and the NASDAQ at up 61. There is apparently a hidden force here that helps markets recently move up, and it seems to be moving up on a regular basis. I cannot exactly put my finger on it, but it doesn't matter because we're using technical analysis here aligned with some of the fundamental backdrop and long-term trends to understand what's going on. So where are we now? Data doesn't matter. Clearly, the economic information and earnings that are pouring out does not matter to markets, or it would not be holding up on this 50% retracement level that we see on the right-hand side here. The Gilead drug, Remdesivir, however you pronounce it, with the R, that last week on Thursday and Friday really rocked markets higher because there was a report out of Chicago that a very small group that was not a statistically significant, nor a group that was, or a study that was done in line with norms of a double-blind study, et cetera, and because it was a very small group, showed some really good promise. That was last week on Thursday. Gilead was up 7 or 8%. Market said, oh my gosh, that's fantastic. We got some kind of treatment. And I think a lot of people that really didn't understand this, quite honestly, got caught up in the moment and thought it was a cure, which it was not. And they got caught up with the fact that this news item, even though Gilead came out and said that it was not statistically significant, and the newspaper that wrote it, Stat, or the online blog that wrote it, Stat, said that they have no idea why this is moving markets. It makes no sense. It is not a complete study by any means. Well, fast forward a week here, and what we saw was a leak, an accident by the WHO, the World Health Organization, that somebody accidentally put the results of another trial on the website, which was negative, saying basically there was no benefit to this drug at all. Now, immediately they were told to take that down. Immediately, Stat came out, Gilead came out. Everybody was like, oh, that study is not significant. Trying to shelter, I guess, the markets and the stock. Gilead stock dropped, as you would expect it did, and the markets came in. The markets were pretty up nicely in the midday yesterday. Once this news hit, everybody's like, oh, no. Obviously, we're a lot further away from a cure or any kind of treatment than we thought. So with that, we're finding that there is a narrative that continues in the market that, listen, we're just going to totally disregard this quarter's earnings. And I think that's reasonable to assume because we don't know what the outlook is going to be because company after company is pulling not only next quarter's, but fiscal year 2020 guidance. That's a problem. And yeah, somebody's mentioning, Dean is mentioning that the WHO released report was based on a Chinese study in severe cases that was stopped for lack of adequate number of patients to read. Yeah, statistically, I get that. I totally get that. My point is both sides of the information, what I'm trying to share with you is that we're seeing the market react and hiccup on every piece of news. And it's frankly the tape readers, the algorithms, the high frequency traders that are in there that are moving markets like this, and it makes no sense at all. However, what we do know is that we do not have the information to make a reasonable assessment of the effectiveness and efficacy of the Gilead drug. That's number one. Number two, any particular treatment we haven't found. Number three, any other drug, there has been not a peep out of the benefits. And no, don't drink bleach or go out in the sun and bake yourself to try to get rid of the coronavirus or just keep out of it. That information that was floated yesterday is absolutely ridiculous. So use all this with care. Remember, there's a lot of underlying stock market, I don't want to use the word manipulation, but pushing that goes on. So, but yeah, the earnings are in a disregard mode, and I think that is reasonable to do. However, when I do all my calculations, when I bring on people, I had a discussion with Frank Curzio this week on Twitter Live. If you're not following me on Twitter, I really encourage you to do so. I'll push that in the chat too. It's very simple. It's at Andrew Horowitz. Hopefully I'll spell it right as I talk. There you go. Make sure to follow me on Twitter because there's a lot of good information that we put out there and also links to everything, as well as our Twitter Live when we go live and talk about things like we did this week with Frank Curzio. We talked about the fact that, even if we expect $150, which is really kind, that is really great to see. If we only chop from about 163, 165 on estimated earnings for 2020, move it down to 150, we're still at about an 18.5 multiple, which is the level we were at the highs of the market. So consider the fact that right now, when we look at where we are and question the idea of, should we really be at those levels? That's something we need to deal with. But markets are running on every story and every blip and every blurb and every headline. So just be careful with that and understand that the ranges right now, this is really important. The ranges right now are really wide. The VIX is above 40 or right at 40. That means there's going to be substantial movement on a daily basis on an individual stock level, even ETFs, as well as the overall markets. Therefore, if you don't want to get caught and burned, what you need to do is make sure that you have a high confidence when you get into that trade and also trade at lighter levels. Don't expand the trade so significantly that it's going to hurt you in a dramatic way. On the economic front, initial claims, we have 20 plus million jobs that were lost. We pretty much wiped out all of the jobs that were created since the financial crisis. Really kind of very disturbing. But is it priced in? We saw a negative number, much greater on durable goods orders this morning. I think it was negative 14%, looking for like a negative 8. But look, futures don't seem to care. Futures are like, who cares about the economics? Things will get better sometime in the future. What they're not calculating, and I think what's the problem about what's not priced in here, is the potential for an elongated process that we don't get things back up and running much faster. In addition, I think one of the other things that you're seeing is when we see a negative number that's severely negative, the realization that next month or the month after or the next quarter is going to see a turnaround from that. We don't get this continually flowing down unless we go into an absolute outright depression. So I think what you're having is a situation where people believe that moving forward with regard to where they're going to be sometime in the future is really going to line up pretty favorably against the last month. So if durable goods pop up a little bit, you're going to see a great number next month, and markets will cheer that probably. A lot of you are probably thinking, what in the world happened with crude this week? I mean, we saw the May contract go to negative 40 right before the close and the final roll into the June contract. And then the June contract the next day went from like 20 something down to 6, currently trading, I think, around $17 right now. Do we have it up here? Right there, $17 and 15 cents, up a little bit this morning. I think markets are also running with crude and thinking that things will get better in the future. And there's some potential promises by the government that a lot of the companies in the industry will be backstopped and production will be slowed down. And even if production is halted, the administration may keep on paying the oil drillers, refiners, energy sector, which is madness, in my opinion. We've gone from a situation where we had a market that was running, and it was running on what should be, I believe, a capitalistic structure, to now an outright socialist structure where the government is going to buy or pay for everything. I don't know how we get out of this. I don't know how we're going to get better. But what happened in May was, or the May contract last week, and yes, it went to a negative 40. And I want to mention something. There is a great possibility that by the time the June contract comes to the roll, to the final close, when delivery is going to have to happen for anybody holding that contract, if in fact we still don't have enough places to store it, because every tanker, every hole, every empty swimming pool, I mean, everywhere that was available to store, this is totally filled. Nobody wants it. So the people that own it are saying, you know what? I don't want this contract. I don't want to take delivery of 1,000 barrels worth. You take it. I'm selling it to you, but you know what? I'm going to pay you to take it. That's what happened here. So I think when we look at the overall structure of what's happening with crude, the oversupply, even though May 1st, OPEC Plus is going to be cutting back 10 million barrels a day, we still have a net 10 million barrels per day of oversupply. What will cure that clearly is getting back to work. So we have to watch for that. Yeah, I mean, this question, should we fill the strategic reserves with cheap oil? Absolutely, but there's a cap on that as well. There's only so much we can hold in all this. USO, be very, very careful, and other ETFs that invest in these commodities are broken. In fact, the USO ETF came out a couple of days ago and talked about how they've changed their structure entirely. What they did was they were utilizing front month contracts. They were using the current contract, and that's where you'd get your exposure, and that's why it lined up so well historically. About 2 weeks before, they would roll it into the next contract. With all the contango that we're seeing, or in other words, the future contracts beyond the current contract, so from the June contract, let's say, to the August contract, there's a big price difference between the two. Because of that, there was a problem which is called contango, where they have to be rolling into the higher price, and that's a problem. What the USO ETF is now doing, and you should read more about this, is what they're doing is they're investing across the range of the curve. So they're looking at buying, let's say, some on the front month and June, and they're going out to August and maybe September and maybe December, but they're buying a bit into it entirely. There has been some speculation that the actual NAV value and the underlying intrinsic value of USO underlying the price where it currently trades, which is like $2, is about 25% too high. So the intrinsic value is 25% lower. That's something to consider, especially if they keep on now changing their way of doing things. So these are broken. These are places that are really difficult to invest. If you have to invest in oil, I would say look at the futures, but I would be very, very careful. There are not many good places really to put your money that work the way that you want them to. I had some people call me last week and say, hey, Andrew, I want to buy oil. This is a friend of mine, he lives in Texas. He never invests in anything. He's got cash. He's got money markets. He's real estate. He said, I want to invest in oil. I want to put a chunk in because I figure, 10 years from now, oil's going to be higher. We're not going to have a situation where we don't need oil ever. I said, okay, that's a reasonable discussion. He says, how do I do it? I said, I can't give you a good way to do this. If you do futures, you're going to get caught with the contango. If you buy things like USO or OIL or name whatever one you want to look at, they have a broken structure now because of the way that the market is working. And there's a bigger issue here. Realize that many markets are broken right now, and the only reason they're holding up is because of the graciousness of the Fed and the stimulus programs that are going on, which brings me to the fact that the PPP program, the Payroll Protection Program, has been funded again. A lot to talk about this morning. We'll get to the stocks in 1 second. There will be bankruptcies, malls, retailers. We'll talk about JCPenney today, XRT. Georgia's reopening. I don't know what you think about that. Maybe chat with me and tell me what you think of this. Georgia opening up bowling alleys, massage parlors, tattoo stores, nail salons, hair salons. A little too early, especially because they don't meet the criteria to enter into phase 1 yet anyway. Questions? Or is this maybe the test group? Is this possibly the area that we're going to say, okay, well, what happens if we open up and we go full force and let's see? Is this a sacrifice? I mean, is somebody making a major sacrifice saying, hey, if you open up and things get worse, you know what we'll do? We'll back it off. I don't know. Next week we have coming up consumer confidence, GDP, FOMC rate decision, no change probably there. Personal spending prices, PCE prices, which will be interesting. That is the Fed's preferred measure of inflation. ISM manufacturing. We're going to talk about a variety of stocks. How about we get to that right now? Why don't you, in the chat, I'm going to write the word here so everybody knows. Everybody, I need your participation. So if you have a stock or an ETF that you want me to look at, or a future, put it in the chat. Right down at the bottom there. See it? Right down there? Right down there? I want to talk about what you want to talk about today. By the way, I'm going to mention something else. On Mondays and Wednesdays at 4:30 p.m. in the afternoon, we do a Q&A pop-up webinar. Everything's on the table. Any financial question you have, we've got an amazing amount. This is kind of our money management part of the business that we do manage money. So just to let you know, we built these indicators for our money management business and then repurposed what we did for the TradeStation trading app store as TradeStation asked us to do that for them. But you can join that. Go over to thedisciplinedinvestor.com. On the top right, there's a registration area right there. All right, what do we got? I want to look at a few things. I want to look at, one of the things I look at every day is the movers. So here's the movers. See that right there? You got we look at the equities, all percent changes one day, and you can click these down and take a look. If you haven't seen that, it's in your apps. and you can open up and put in a level of these charts, which are called hot lists. And when you look for the hot lists, which I can't seem to find on my thing here somehow, I don't know. Let's see. Let's look through here. Hot list right there. See the hot list? Click up the hot list. It brings up something like this, and you could change it to anything you want to do. Percent gainers 5 days, 10 days, movers in the last 2 minutes, gapping up and down, whatever you want to look at. Well, I like to look at the movers, the biggest movers of the day, and the losers for the day. So we got things like JCPenney looking for bankruptcy, down 13%. Movado, nobody buying watches right now, and if they are, it's probably digital, down 9%. Overstock.com down 6%. On the upside, you look at all this. So that's one thing that I look at. The other thing I want to look at right now is how we're doing here. What are we seeing here? We're seeing a roll over the spearman. We get below zero is a problem. Seeing markets try to hold up in this range, and that's the INX, the S&P 500 cash contract. Seeing the McClellan a little bit higher. We're seeing that's the advancer decliners and a few other calculations put in there. And 52-week new highs coming up a little bit, which is good to see. Up 21, it was down by like 4 or something like that. 210 back here a couple of months ago. All right, let's get over here. Let's look at crude for a second. So this is the current contract right now on crude. What are we seeing? Well, we're still in a pretty much of a downtrend here. There's no question about that along the line, right? I mean, we've been this downtrend for a while here now, and I think that it's probably going to continue for some time. I mean, look at this downtrend that we're seeing here, right? It's pretty defined. That's a little bit wider than it actually is. But if you think about that, what do we have to do? Probably have to get above this level here, above this level of 22. And I would think also that this level here is going to be a major resistance kind of in the 25 level that you're going to see. So that's crude oil. The other problem I mentioned that as you get closer and closer to the time when the contract's going to roll, and if you're holding the contract, you take delivery of 1,000 barrels. I don't know about you, but I don't have a tanker. I don't have barrels because you have to actually pick it up. It's not like you just get delivery, they show up at the truck one day. You have to have a lot of things in order to get the delivery. I don't have that. You don't have that. We don't have that. We couldn't do it if we wanted to. So you have to be very careful right now with if in fact there is a significant amount of reserves or of a supply that's out there and nowhere to hold it right now, may have a problem. All right, what else we got? Gilead. Gilead is up 63.49. This is on let's make sure we got here. So I want to show you what happened yesterday. Let's kind of go here on 60 Minutes. We did see that giant gap down when the study came out yesterday. Very difficult to catch that, but it is trading a little bit higher than that, but still, I think it's very tentative on Gilead. Gilead has had a really nice run. You can see since February, it was that bounce off and a lot of green, which shows, these long biases overall on the Gilead positioning and also an aileron. Aileron is, in fact, a separate indicator, but you can attach it to the Commander Series, which is what you're looking at right now. The Commander Series comes with the top line. I always tell you this, the radar, which gives you a multi-time frame across one row, which no one else has. We were able to call this. Even TradeStation said, you can't do it. We did it. Across one line, you have 30 minutes, 60 minutes, 240, daily, weekly, or whatever combination you want with a minimum of 30 minutes. And what you're seeing here is that we can go from right, start on the right side, then we go on the left. We go to right, we start going across. And what we get is a sense of what the longer term trend is and the shorter term trend. If they all line up in the same color and the same bias, long, let's say, you have a greater degree of confidence in the trades on the short term or the long term. If in fact there is something that is showing up a bit differently, look right here, SPY. Got a short alert on the 30-minute from yesterday. We got a long alert on the weekly, and then nothing in between, no confidence. In fact, if we look at this, I would dare say that, yep, we're in a range right here. We're in a range that is pretty tight. Now, I want to show you something and bring you a little lesson in something here. I want to bring this back up. And I want to quickly go through setup signals. I think there's going to be more of an educational session today, but I want you to look at Expedia right now. Expedia, here's an interesting setup, okay? This is a daily chart of Expedia up till yesterday afternoon, I believe it was. I think Expedia has actually got an upgrade today. But look at this wide range. You see this wide range that we're seeing over here? Right here, it's just this big range. And we have also this line, the yellow line, which is the high volume node inside of the radar. So what we have going on in this chart right now is autopilot, altimeter, and radar. Radar is a granular look of the altimeter broken down on a price and volume, and also what it looks at is what's called a traditional market profile. So when we're looking at this and we see what's going on here, we see this big range going on, but I want to back it up for a second. Let's go back and let's look at this area here. Number one, so we saw a great level of there was a tight level of consolidation. Anytime you see very thin lines of consolidation, it's a very interesting area to be kind of looking at. In addition, if you look at this, and I'll see if I can draw this. Is this it? Freeform maybe? See that? Well, that's not exactly right. Let me draw that again. We got this. There we go. It's a big B. It's a big letter B, capital letter B, right? You see that? Let me clear that so you can see it yourself. Right, that radar right here. There's some area of accumulation on the top, nothing over here, and then area of accumulation on the bottom, right? See that? Area of accumulation, nothing. Once you broke through this level here, once you got through the level right here, see this? There is nothing really down to about here. Well, let's draw that, and let's draw this. So the breakdown from 110 down to 94 was pretty easily to be seen here on Expedia. Then you got a new altimeter that was drawn with a really decent base right here, but then you got another short signal. Let me take you through that. Right there, another short signal. Once that short signal came, you knew that you were in a downtrend. You probably looked at your radars, you looked at your altimeters, you looked at your directional move. You see that the altimeters on this chart are showing lower altimeters. We're getting lower and lower. And then there was nothing to the left. Look to the left. Look over here. Look in this range over here. Right below this level, there's nothing. That steep drop that we saw up to this point was clearly identified, and the gap downs in the areas that we're seeing here were very clear. Down to the level, again, where we got a brand new radar that formed, a new altimeter, and it took you out. So you got a short from about 110 down to about 94, another short down on 95, another short about 94, held on to about 50. Not bad, right? So what you have and what you're contending with now is number 4 on this chart. Number 4 on this chart shows a high volume node inside of a regular distribution of a radar. So let's go through that. Let me show you. See this? See this? Capital D. See that? You can draw it out a little further if you want. It's a big fat D. If you draw it, you could find that this, see again, I'm going to just draw it again for you. Right here. See that? That's the radar. See that? The multiple lines behind, right? These multiple lines behind here. So right now, the high volume node from that area, the most traded is right here at about 61.42 or so. What that is telling us is that level is a major area of resistance. You need to get over about 66.49. Well, let's take it back right now and take a look where we are with Expedia right now. 65.73. See, again, we saw, take a look at this same chart we're looking at right now, but live. You got up to the level of resistance and it backed off. You see all the gray? The gray is showing you in a consolidation point. Now you could trade if you wanted to, for example, let's say you want to go from the bottoms to the tops and I short and I go long and I go short and I waited for this to come down, but it didn't. I go, maybe you got taken out of this because it couldn't break down. Once it went up, you took it yourself out. And here you go short again in theory. Right now trading at what? 65. So it's trading still under 60. Let's take a look at that. Let's take a look at that. Yeah, you got to get above 67 for this to even work. But my point is, it gives you some very clear signals on this. JCPenney, just a horrible look. Nothing there, down another 12% below levels, even though we're seeing a bit of a reversionary kind of trade against the grain right now from the aileron. I mean, it's just nothing to look at right here. If you want to take a shot on this and maybe, I don't know. Netflix down a little bit today, but obviously holding on to this is big old, this level of just kind of crazy level of up as people are watching from home. We went through Gilead. I'll go through gold real quick. And market's opening here. Go through gold real quick. Gold on a breakout needs to get above this level, 163.15, right where it's on right now. It's turning yellow. See, live, it turns color. It turns yellow right now. Silver not looking the same here. Big overhead resistance on silver. Big gap in here. And Intel is down about 3.5% today on good earnings numbers, but questioning whether or not Apple is going to continue with utilizing their products, and some outlook that was a little bit disappointing. With that, we're finishing off. Futures up 240 on the YM, on the Dow, and 27 on the SPOOs, and 60 on the NQs. I would not be surprised to see a little bit of a take back today as we get into the close. I think people are still shy about the weekends to a point, but I think they want to get back what they lost yesterday with that whole number that came out. Markets trading, of course, very wildly, very thin. You can see moves, pops, drops at any second. Be careful. Make sure to check out all the things that we have available on TriggerCharts.com. I want to thank you for being with us today, and I will see you again next week.